Welcome everybody, thanks for joining this webinar today where I will discuss gold. Just a brief intro on me. My name is Chris Ashton. I am the head mentor at the Corellian Academy. I was a trader for 20 years, first at UBS and then Barclays, during which time I experienced trading gold and silver amongst my various other roles. Since leaving, I focus on delivering content on what's happening in financial markets, and in this capacity, gold and other precious metals have been grabbing the attention of many traders recently due to their big percentage gains so far in 2024 and the resulting increase in price volatility. Today, to help you increase your knowledge of CFDs that are available to trade on the Plus500 platform, I'm going to discuss what is gold and why you may want to trade it, highlight some of the options available to you on the Plus500 platform if you want to trade a CFD with exposure to gold, lay out some of the key drivers that can impact gold prices before moving on to run through a case study from the start of May, and then finishing by outlining some potential developments that could have an impact on gold prices as we move into June. My focus is to identify some of the things a prospective or current gold trader could consider, and in the case study, provide an example of a risk management process you could utilize each time you trade. As we go through this webinar, it is important to understand that there are signals that come from the markets, and these opportunities can potentially be seized upon to create a positive outcome, although that may not always be the case, as there are always unforeseen factors that can negatively impact even the best thought out and planned trades. Okay, so what is gold? Let's start with the basics. Gold is not just a shiny metal. While it is used in jewelry, it has also various industrial applications due to its high conductivity and resistance to corrosion. It's one of the oldest forms of currency, and historically, it has been a symbol of wealth and a hedge against economic uncertainty. In trading, gold is viewed as a commodity, sitting alongside other precious metals like silver and copper. It is traded globally in various forms, including physical gold like bars and coins, as well as futures, options, and ETFs. Although I should say today I will focus just on the CFDs available on the Plus500 platform. Okay, so why trade gold? Trading gold offers several benefits that can attract investors and traders. Number one, as a hedge against inflation. Gold has historically maintained its value over the long term. It's often seen as a hedge against inflation because its price tends to rise when the cost of living increases. Number two is safe haven. During periods of economic uncertainty or geopolitical tension, gold is considered a safe haven asset. Investors often buy gold when they believe that other investments like stocks or bonds are likely to decline in value due to economic instability. Number three is diversification. Including gold in a portfolio can help diversify investments, which can potentially reduce risk. Gold often has a negative correlation with other major financial assets, meaning it can perform well when other investments are underperforming. Number four is liquidity. Gold is highly liquid when compared to other physical assets like real estate. This makes it easy to buy and sell, which is attractive to traders who wish to quickly adjust their portfolio in response to market conditions. Number five is store of value. Gold is used as a store of value for central banks and individual investors alike. Central banks hold gold to protect national wealth and to provide security against economic crisis. Bloomberg recently reported that in Q1 2024, purchases of gold by central banks, led by China, were the strongest on record, which goes some way to explaining the recent strong up move so far this year. Okay, so how can you gain exposure to gold using CFDs on the Plus500 platform? One of the easiest ways is to use the gold CFD, and the price chart for 2024 is on screen for you now. Remember, gold trading prices are expressed in dollars. After opening the year at 2,063 and slipping to a brief low of 1,984 in early February, gold steadily increased to a high of 2,431 on April the 11th. It cooled off briefly to range trade between 2,277 and 2,378 before soaring back above 2,400 again in the last week, where it hit a new all-time high at 2,450 before quickly reversing back lower. Other alternatives for traders who want exposure to gold are the CFDs of the individual mining companies. Some examples of these are on screen for you now, although there are others that you can choose from. Using the price chart of Goldfields, who is a producer with annualized production of around 2 million equivalent ounces of gold from their operations of 6 mines as an example, you can see the price chart initially follows a similar pattern to gold, hitting lows in February and yearly highs in mid-April before settling down to trade at lower levels. However, it never fully tracked the recent spike higher in gold to the all-time highs last week. And because of this, it's important to note that while CFD prices of individual mining companies will be influenced by the direction and sentiment towards gold, they are also influenced by company-specific issues like production delays, bringing new mines online to increase production, earnings reports, and forward guidance from company executives. The second alternative are our ETFs. To find them on your Plus500 platform, go to Trade, scroll down to the bottom of the instrument list on the left-hand side where it says ETFs, click on Commodities, and they are all listed here for you. GLD Gold tracks the daily price movement of gold. NUGT tracks performance of the New York Stock Exchange ARCA Gold Miners Index, and the Commodity Index Fund tracks the daily price movement of the biggest companies in the commodity sector. Okay, let's look at some of the main drivers of price moves for gold. These can broadly be grouped into 6 general categories. Number 1, global economic stability. During times of economic uncertainty or instability, gold prices typically rise as investors seek safe haven assets. Conversely, when the global economy is strong, gold prices may weaken as the demand for riskier, higher yield investments increases. The next category is monetary policy and interest rates. Central bank policies, particularly those regarding interest rates and quantitative easing, have a significant impact on gold prices. Lower interest rates decrease the opportunity of holding non-yielding assets like gold, potentially make it more attractive. Conversely, when interest rates rise, gold, which doesn't offer interest or dividends, might become less attractive. Number 3 is currency values. The price of gold is typically inversely related to the strength of the US dollar, meaning a weaker dollar makes gold cheaper for investors holding other currencies, potentially driving up demand and prices, and conversely, a strong dollar may suppress gold prices. Number 4 is supply and demand dynamics. The balance between gold production, supply, and consumption demand can also affect its price. This includes mining output, central bank purchases or sales, and demand for jewelry and technology. Number 5 is geopolitical uncertainty. Gold is often sought after as a safe investment during times of geopolitical instability. Conflicts, wars, political unrest can lead to increased purchases of gold as a security against uncertainty. And you can see this impacting the gold price early in April 2024, where gold prices spiked as Iran and Israel traded retaliatory drone strikes. And then they cooled off as the conflict de-escalated into the end of April. Now, the final category is market speculation. Speculative trading can also influence gold prices. Traders' expectations about future prices can create short-term volatility. The big year-to-date gains in gold have attracted more speculators, especially from Asia, supporting the market in its move higher, but leading at times to nasty sell-offs as traders all rush to exit weak positions at the same time. You can see this happening on the price chart on screen now. These unpredictable price moves are something that can impact the best planned trades and are something every gold CFD trader must be aware of. Now, that's the basic categories. There are more detailed considerations that traders and investors use to analyze and predict movements in gold and the related CFDs, but that is for a different webinar. So that's set the scene. Now let's move on and consider the case study. This case study is focused on providing an example of how you could have traded the gold CFD and risk managed a live position during the week starting on Sunday, May the 5th. The trade idea formulating is that to identify a level to be long gold with a defined stop loss below which I am happy to exit my position. My reasoning behind this trade is that gold has just fallen aggressively in the previous week, even though the Federal Reserve stated they were still considering rate cuts in 2024 and the dollar had turned lower as US employment slowed. Usually two reasons that would help support an up move in gold prices. This led me to think that the sell-off was just a capitulation of weak speculative long positions, and once this short-term period of volatility was over, prices may start to rise again. With this in mind, my first consideration is trade planning in advance of the event. Now, I can do this over a weekend or at the start of my trading day, but for this example, I'm completing my planning over the weekend to be prepared to trade on Monday morning if the environment and price levels are favorable to my trade idea. In this section, I will use terms such as stop loss and take profit orders. A stop loss is an order I can enter in advance on the Plus500 platform to close my position at a defined price level I have planned for, which limits my loss in the event of an unfavorable move. A take profit order is a different type of order I can enter in advance to close my position at a defined price level I have planned for to profit from a favorable move in the instrument I'm trading. So step one, I need to check the economic calendar to highlight any events that may impact the direction of gold in the week ahead. To access the economic calendar on your Plus500 platform, click Menu, Tools, Economic Calendar, and there, as you can see, the economic data for any given day and/or key central bank meetings are listed for you. I use this tool in this example to confirm that economic data across the upcoming trading period is very light after a busy previous week, and that there are interest rate decisions from the RBA in Australia and the Bank of England in the UK, neither of which should directly impact the direction of gold, but are worthy of taking note of. Step two is to identify some tradable levels. Looking at the price action from the week before, which was April the 28th to May the 3rd, I see that prices rallied from initial lows on Wednesday, the 1st of May at 2,281 to a high of 2,328 after the Fed rate decision and press conference, before falling back to a low at 2,277 on Friday, and then rallying again into the Friday close to end the week at 2,301. And that was after the release of a below expectation US non-farm payrolls report. I have now identified two things. The first is that the negative trader sentiment potentially has been exhausted in the short term after trading to the 2,277.85 region 3 times and then bouncing. The second is that I found a support level at 2,277, the low from Friday, May the 3rd, that stopped selling on previous occasions, and a level I hope will hold further selling on any moves lower. Now, I am keen to see how the market opens on Monday. If it stabilizes around this 2,300 area, I would be happy to buy, anticipating a move higher later in that day or across the week. The final consideration is trade execution. The market for gold initially opens on Sunday, May the 5th at 2,304, but falls to an early Monday low in Asia at 2,292 before it stabilizes between 2,300 and 2,310. So step one, I buy at 2,310 and I place a stop loss to protect my position on the downside if the trade goes against me at 2,270. Just below that low at 2,277, I identified from Friday, May the 3rd. I set this stop loss on the Plus500 system. So step two, next I want to assess viable take profit levels for my live position if I'm correct and the market does move higher. To do this, I use the Fibonacci retracement tool on the Plus500 platform. First, I pull up a 4-hour gold price chart. I click on the draw icon on the top left and then choose the Fibonacci retracement tool from the menu. I click on the all-time high at 2,431 from April the 12th and then click on the low at 2,277 from May the 3rd. That provides me with 3 upside resistance levels I want to consider for my take profit level placement. These are the 38.2% retracement at 2,337, the 50% retracement at 2,355, and the 61.8% retracement at 2,373. I decide to place my take profit at 2,370, just below the 61.8% retracement level at 2,373. This is a level the market has traded up to previously, so I anticipate it can do so again if the dollar weakens further and sentiment moves back to be more positive for gold. I set this take profit order in the Plus500 system in advance as well. Now, in this example, I am happy to sell at this level. It's irrelevant to me whether the market may continue higher or not. I have achieved my goal and can walk away in a positive frame of mind, ready to look for my next trade. So in summary, as I let this trade play out, this is a planned trade. I buy gold at 2,310. I set my stop loss on the Plus500 platform at 2,270, just below that May the 3rd low at 2,277. And I've set my take profit on the Plus500 system at 2,370, just below that 61.8% Fibonacci retracement level at 2,373. As you can see, my target was hit at 2,370. Now, to be clear, this isn't investment advice, but just one example of how you could have traded the gold CFD on the Plus500 platform during the week commencing May the 5th. Now, just before I start responding to the many questions, I wanted to highlight 2 areas that I think will be important for the direction of gold going forward into June. The first is the critical period for US events. After a below expectation print the previous month, the next non-farm payrolls release on June the 7th will be important. Traders will be looking to see if the unemployment rate has moved higher again, and if it has, how quickly it has jumped. US CPI is the next release on June the 11th. Traders are looking for inflation to start to slow again after stronger prints in the previous months of 2024. If inflation has peaked, it opens the way for the Fed to start cutting interest rates. Then on June the 12th, it's the Fed interest rate decision and press conference. At the start of 2024, traders were hoping this would be the meeting that the Fed started to cut interest rates. That now looks unlikely. But gold prices will react to what Fed Chairman Powell says on inflation, the economy, and the likelihood of the Fed cutting in September. The second area to focus on for gold traders is geopolitics. Issues in the Middle East, Ukraine, are still ongoing, and tensions are currently high in the South China Sea between China and Taiwan. Markets are in a period of uneasy calm, but any headlines flagging the potential for re-escalation or a more peaceful resolution could see gold price volatility increase quickly. Right, on to the questions.